Hi, this is the Business Guy. So how do you do pre-market and after-hours trading? Some of the most important stock market moves can take place outside of the 9:30 a.m. to 4 o'clock p.m. Eastern Standard Time regular trading session of the New York Stock Exchange and NASDAQ. So how do you do stock trades in the pre-market or after hours? How do you get a jump on the competition and buy or sell stock when you see some breaking news about a company, an earnings release, a major news event? What about the futures market? We'll answer these questions and more, but first do me a favor and click the like button so YouTube promotes this video. Thanks so much. And if you haven't, you can also click the subscribe button below so that when more videos come out like this one, you'll be up to date right away. So here's how to do pre-market and after-hours stock trades. You trade stocks on the ECNs or Electronic Communications Network. It's a mechanism that enables traders to participate in extended hours stock trades. ECNs are electronic trading systems that automatically match buy and sell orders at specified prices, allowing major brokerage firms and individual traders to trade directly amongst themselves without requiring a middleman such as a stock exchange market maker. So who can you do these trades with? You can do pre-market and after-hours trades with companies such as Charles Schwab, Fidelity, Robinhood, Webull, TradeStation, and others. Now, most orders placed through ECNs are usually limit orders. In other words, I want to buy this stock at this price or lower, or I want to sell the stock at this price or higher, which is fortunate given that after-hours trading often has a notable impact on a stock's price. So when can you trade? Pre-market trading in stocks occurs from 4 a.m. to 9:30 a.m. Eastern Standard Time, and after-hours trading on a day with a normal session takes place from 4 p.m. to 8 p.m. Many retail brokers offer to trade during these sessions, but they may limit the types of orders that you can use. Now, one important consideration is that the level of liquidity is typically much lower when trading outside of regular market hours. So there are fewer shares available to buy and less supply from those who want to sell. So your trade might sit for a while before it's fulfilled. Plus, the spreads between bid and offer prices are often wider, and the thin level of trading can cause a higher volatility, carrying with it the associated risk and opportunities for that matter. Now, many people follow the often volatile pre-market trading session to gauge the market outlook ahead of the regular open. Price volatility is driven by forces outside of the regular trading session, and knowing how to trade stocks and futures during this period is an opportunity for investors looking to get a jump on the competition. After the close is important as well, as investors take stock of the day and make trades that might have been too volatile directly at the close. Usually the biggest market moves occur when the number far exceeds or misses the expected forecasts, creating high volatility and the trading risk and opportunities that accompany it. Earnings releases. Earnings releases refer to the period in which publicly traded companies release their earnings reports. Earnings sessions start 1 or 2 weeks after the end of each quarter. Consequently, most companies release their earnings in early to mid-January, April, July, and October. Now, during this time, company earnings are generally released before the market opens or after the close, often causing a substantial price move in the underlying stock outside of regular trading hours. As with economic indicators, the largest reactions typically occur when a company substantially exceeds or misses expectations. Having access to extended hours allows the stock trader to react quickly and potentially capitalize on the initial reaction to positive or negative news. Now, that being said, the people who make the most money in the stock market look at company earnings and expected earnings compared to the price, not those who play the quick hit fluctuations. Now, that being said, major news events can impact a stock price. News and announcements of major geopolitical events are often reported after regular trading hours or over the weekend, potentially causing a massive market move. Wars and natural disasters are examples of unexpected events that can take the market by surprise at any time. So having access to the market before the market open allows you to better position yourself and hedge against risk in the case of such unforeseeable events. The futures market, especially the benchmark S&P futures contract, is closely followed in the pre-market session to gauge market sentiment for the day. Futures contracts are standardized contracts to buy or sell an asset, such as stock, at a predetermined future date and price. For example, a stock is selling at $200 a share. I'll put up $5,000. and I'll bet in 3 months the stock will hit $220 a share. If the stock hits $250 a share and you exercise your option, perhaps you'll make $50,000 or so as an example. And naturally, that's just an example, so the amount that you make or lose depends on how much you're trading. Now, stock index futures are futures contracts on financial indexes such as the Dow, NASDAQ, or the S&P 500. The Chicago Mercantile Exchange, E-mini S&P 500 futures contract, is the world's most actively traded stock future index. Trading virtually 24 hours a day, the E-mini S&P 500 futures can indicate how the market is likely to trend at the start of the New York session open. S&P 500 futures are often used by money managers to either hedge against risk over a certain period of time by selling the contract short to increase their stock market exposure by buying it. In addition to offering market access almost 24 hours a day, the major benefit of trading the E-mini S&P 500 futures is the high liquidity level. The bids to offer spreads are consistently tight, and the spread is effectively a cost of entry into the market. Tight spreads are critical because the wider the spread, the more the trade has to move in your favor just to break even. So that's how to do pre-market and after-hour stock trades. Please like, subscribe, and share this video. This is the Business Guy.